Can you start investing with just $100?
Yeah.
There's like an app that helps you understand before you start investing. What would you recommend?
Yeah. Rather than you buying one share of every single company, you can invest into an S&P 500 fund, and that fund will own all 500 stocks.
Suddenly the market crashes, your money goes down, and what if a company was bankrupt?
Companies often fail. The financial sort of industry is a bit like snaky. They purposely make things sound complicated so they can charge people high fees.
How does the person scale up?
Invest more.
Welcome to another episode of Australia Unfiltered, where we have candid and insightful conversations with people living in Australia. This episode is powered by Dropout Chaiwala, and we would like to give a special thanks to Aussies Group for this amazing podcast space. So today we'll be talking about a topic that I am really interested and I totally suck and have zero knowledge about, but I was really keen to talk about it. And funny story how I got Ryan. Like, I put out a post on LinkedIn, and I think mutual of us, he saw it and he's like, oh, you should get Ryan. I was like, okay, fine. And I saw it on LinkedIn and I was like, he just works at EY. How does he right candidate? But I'll tell you how he's the right candidate. So, and then I checked your Instagram and I was like, oh wow, damn, I would love to get him. And then I was like, would he even reply to me? So then I told Harsh, I'm like, can you like intro us or tell him that I'm going to message? And then I messaged you.
Harsh slid into my DMs first.
Yeah, and then I slid into your DMs. Yes, for
One
sure.
after the other.
Just for like a background, I forgot to tell you. Forgot to tell you guys what we're going to talk about. I started talking about you. Yes, I'd love to talk. But anyway, so today's topic, really interesting and I think really needed, is how to start investing as a beginner. When you're a beginner, it's so confusing. There's so many options and you're like, should I put my money here? This person's putting their money there. Someone is stock trading and they're making tons of money, but someone is losing money. So I was like, let's just start with basics. And then Harsh recommended you. Background on Ryan, do check out his Instagram. It is Money Making Simple.
Making Money Simple.
Making Money Simple.
Close.
I'm sorry, guys. I'll put the link in the description. But Making Money Simple. Yes, Making Money Simple. I remember. It's in a book. But anyway, Ryan is an accountant. He's a personal finance content creator. I'm so sure you might have got it by now. And he is also an author. And just by the way, he's just 27. And when he told me he's 27, I was like, what the hell? Like, how have you done so much at 27? But he's the author of a book called Stop Waiting, Start Investing. Welcome to Australia Unfiltered, Ryan.
No, thank you. I'm glad to be here. Thanks for having me on. Good introduction.
Yes, and we had a blast before this as well. I've never had that before. My just like it doesn't sound wrong. There was a mosquito. Yeah, I don't know. It just sounded so wrong.
It took 20 minutes to get it out of the room, but it's out of the room now, so now it's fine and we can start.
Yeah. Anyway, let's get into investing.
Yeah.
So I'm going to start with the basics. What is investing and why is it important to start at an early age? Or early, just doesn't matter age.
Yeah. So all investing is where you essentially put your money into something and then you're trying to generate a return over the long term. So I guess you think back to, like, in really simple terms, when it comes, you obviously earn money through like a 9-to-5 job or your own business. You can then spend it, and of course you need to spend it on some stuff to live. You can save it, which is good, and you do need to save for some specific things, maybe a house deposit, a holiday, Christmas presents. But the problem is saving for the long term loses out because of inflation. So if you have like money under the mattress or in a bank account, they are right now, but it's actually very rare that the interest rate you'll get from a bank is higher than the inflation rate. So even though if you have $100 in a bank, it'll still be $100 a year later.
It'll be 100 and 100.10 cents, and you'll be like, wow, yes.
And like inflation's actually eroding the value of that $100, so it buys less and less every year, which people don't realize. But yeah, so if you had cash in a bank for years, it will buy so much less than it would have done years ago.
Yes, makes so much sense. You know, when you're saying this, I'm like, shit, I feel so dumb right now. I'm like, I should have started investing before. But anyway.
Well, of course, you need some savings, like an emergency fund, maybe for a house deposit, for a holiday. But then you can spend your money, save it. And then really the only way to build wealth is by investing your money. So that's where you're giving up sort of like delayed gratification. You give up some money today, you invest it into something, and we'll talk about some options. And then over the long term, hopefully you'll make some gains, and that, investment will grow.
And why? And I completely agree. Like, when you're saying all of this, I'm like, shit, I wish I'd not just kept my money in the bank and I'd invested it. But I think maybe I learned something today and then it would be possible. And also I wanted to ask you, because this is investing for beginners, can you start investing with just $100?
Yeah.
You can?
It's never been so. Right now, I think it may be like 10 years ago, 20 years ago, it was much more difficult to start investing. You need like access to certain people and certain level of wealth. But now you can literally just download an app or go onto a website and we can go through a few examples. And with like $10, $100, $500, you can just start investing. So if you're in a developed country, you'll definitely have an app. So in Australia, New Zealand, America, UK, get an app and you can actually start investing in minutes.
But on that, is it like you can also be in a developing country and use an app which is in a developed country, and then you could do that, right?
It depends on like each country has different like rules and accounts and apps. So it sort of depends what's available to you depends on the country you're based in.
Okay.
But it's worth looking online or going on your like app store, typing in investing and just seeing what apps come up.
Okay.
But yeah, luckily like in Australia, in the UK, there's quite a few good apps that we can use, which are low fee. And essentially, for just like $100, you can start investing.
Okay, interesting. And what is the safest, before we go to apps, what are the safest and simplest ways to start investing? So I came up with these fancy terms, okay? I don't even know what they mean, but I'll just read it out. You tell me if it even makes sense. There's stock, there's ETFs, there's index funds, and there's something called as REITs.
Real Estate Investment Trust.
Oh, yeah. I didn't even know what that means.
It's just like a property fund, essentially.
Oh, okay, so whatever, these options came, but what is the simplest and the safest way to, start investing for beginners?
So I would say index funds and ETFs.
Okay, but what is ETFs?
Yeah, so I reckon just to backtrack right to the start.
Okay.
So of course, so around the world, you've obviously got companies and they're all like trying to make money. So they've got like producing goods, services, they've got offices, they've got customers trying to increase revenue and then, make profit, essentially. The successful companies, what they'll do is they will IPO, which is called an initial public offering, and they'll essentially get listed on the stock exchange. So like Telstra is on the stock exchange, BHP, Tesla, Apple, Barclays, HSBC. If it's a big company, the chances are probably listed on a stock exchange, maybe the London Stock Exchange, maybe the ASX, maybe the New York Stock Exchange.
Every country has their own stock exchange.
All the big countries have their own stock exchanges as well. So these are literally real companies that are like producing real products and trying to make money. The really successful ones then list on a stock exchange, and then once it's listed, we can then essentially buy shares in that company. So you can like download an app now, type in Apple, and if you wanted to, you could buy one share of Apple, and then if the stock does well, you'll make money. Apple pays dividends, so you'll get regular cash, and that's sort of how, at that basic level, it sort of works. You have individual companies that are listed, all trying to make money. When it comes to funds, you're talking about index funds or just funds in general? So funds in general, all a fund is like a collection of stocks. You can also get a fund that includes stocks.
What do you mean collection
bonds.
of stock? Like, I'm really dumb at this.
Okay, so one really good popular example is the S&P 500. So that's the largest 500 US companies.
Oh, okay.
So that's like the most talked about. So it's like a basket of the 500 largest US stocks. So rather than you buying one share of every single company in the top 500 American companies, you can invest into an S&P 500 fund, and that fund will own all 500 stocks. So you buy like $100 into the S&P 500 fund, and that then
gets divided over 500 on its own, basically.
Yeah, essentially. So it makes so by sort of investing into funds, you can then get instant diversification across hundreds, if not thousands, of companies. And so I think the easiest way to invest is by using index funds and ETFs. And
what's the full form of ETF?
Pardon? What does it mean?
What's the full
exchange traded fund?
Oh, okay. What's on the exchange?
So they're very similar index funds. So if you, for example, in that example, an S&P 500, whether it's an index fund or an ETF, it'll essentially do the same thing, and it just tracks those underlying 500 companies. So if those 500 companies keep doing well, their share price will go up, and then the index fund or ETF will also then reflect that, and that will grow with it.
Again, I'm a little confused. ETF is the SOP thing?
So it can be either.
It can be either?
Yeah. So you can have an S&P 500 index fund or an S&P 500 ETF. They're essentially the same thing. There are some slight differences, and it gets a little bit technical. But if you're just, say, investing once a month into an S&P 500 fund, whether it's an index fund or an ETF, it's doing the same thing, and it's both tracking the S&P 500 and those 500 stocks that make up the fund.
Oh, okay. So if this
does that not make sense?
Sorry, I'm so confused.
No,
because they sound exactly the same.
They are essentially exactly the same. So the difference is with index funds, you essentially can't day trade them.
Day trade as in trade them during the day?
Yeah, so when the stock market is open, so using Apple again as an example, so I think the US stock market is open from like 9 till 4 every day, US hours. When the stock market's open, you can buy and sell Apple stock.
Yes,
and if you Google just Apple stock,
okay, the timing of trading, yes.
So with index funds, with ETFs, you can actually day trade them. So you can look up an S&P 500 ETF if you've got an app, and you can buy and sell it during the day and try and time the market. With an index fund, you can also have an S&P 500 index fund, but you can't day trade it.
Okay.
So if you invest into it,
do you
the transaction
trade?
happens.
What do you do?
No, nothing. You just put it in order, and then at the end of the day, you'll then invest based on the closing price.
Oh, so you can't change the pricing in it? As in if you bought it, you can't get out of it?
Yeah, essentially. You then have to sell it the next day.
So for stock trading, traders, they do ETFs? No.
So you can day trade ETFs, but I would just say if you want the simplest way to invest, it doesn't matter if it's an index fund or ETF, just invest into a low cost one and then have an automatic monthly investment and then just do that every single month and hold for the long term.
Okay.
But so what I personally do though is I then take it a step further and I invest into global index funds and ETFs.
Okay.
So going back to that example, so obviously an index fund or an ETF is simply just a collection of companies. And the confusing thing is there are thousands of funds.
Exactly my point. How do you know someday something is going up? And then suddenly the market crashes. And then your money goes down. And what if a company goes bankrupt and your money's just gone up?
So that's the beauty of index funds.
Okay.
Companies often fail and go bust. And if you look at 20 years ago, the biggest companies in the world, hardly any of them are still the biggest companies in the world, just like the nature of it being a competitive market. So the beauty of index funds is if one stock crashes and burns, you won't lose all your money.
Okay.
If you had invested into, I don't know, like a recent Australia company has gone bankrupt, if you invested all your money into one company and it went bankrupt, you'd of course lose everything. But if you have invested into a fund that has hundreds or thousands of companies, if one company goes bankrupt, then you've still got other companies in the fund that'll continue to grow.
Oh, okay, makes sense. So that's like the S&P 500.
S&P 500, yeah. So the reason why I mentioned that one is because that's the most sort of talked about and popular index fund or ETF. If you're just investing, it's essentially the same thing. They're just funds. But what I personally do is I invest using global index funds and ETFs.
Okay.
Because the S&P 500 is only obviously American companies. And although America is the biggest and best stock market by a mile and has been for the last 15 years, I don't know which country is going to perform the best over the next 50 years. So I invest into a global index fund, and that invests into thousands of companies all around the world. So then as the global economy grows, that fund then grows with it.
Okay, makes sense. It's getting to make sense, but I think when we start talking further, but for now, let's say I have lowered my option down to ETFs and index funds. Okay.
And all they are is just like a collection of companies. So rather than investing into one company, which is a bit more risky because that will be very volatile, it could fail. No one knows what's going to happen. By using an index fund or an ETF, you'll be investing into hundreds of companies. So it's sort of a more slow and steady way to grow your wealth over the long term.
Okay, makes sense. But even with $100, you'd say to do that?
Definitely.
Because that's a very small amount, right?
Yeah, I started myself with £100 a month when I started back in 2018.
Okay.
So back in England, started £100 a month. And then, of course, don't get me wrong, if you can invest more, you will, of course, grow your wealth much quicker. But
there's a lot of risk. There's equal amount of risk, right?
Yeah. So but I think if you can just get started, the good thing about starting small is though, you can build a good habit by putting away $100 a month. And also you'll realize how volatile the market is. So it's probably better getting used to that volatility with smaller amounts rather than just investing loads of money and then starting panicking when it crashes.
Yeah, totally makes sense. Now getting to the second most important part is what platforms or apps should someone use in Australia specifically to start investing as a beginner? And are there apps? Because I remember one of my friends told me there's like an app that helps you understand before you start investing something. What would you recommend?
So the app that I use in Australia is one called Vanguard.
I saw you, I don't know if you were bashing it, but on your Instagram, you were doing something talking.
So I've been using Vanguard UK for the last 6 or 7 years, and they recently increased their fees.
How much was it and what is it now?
So it's not actually by that much, but they used to charge a 0.15% fee.
Okay.
But now it's £4 a month,
okay.
which isn't that much, £4 a month. But if you only have a small amount invested, say if you only invest £100 a month, £4 per month is actually quite a high percentage.
Yep.
So one of the only really things in your control if you're investing into the stock market, other than your own contributions, is the fees you're paying. Yep. And it's really important to keep your fees as low as possible. Okay. And in this example anyway, Vanguard UK was always one of the lowest fee platforms, but now for beginner investors, because of the fee change, it's actually quite high fee.
Okay.
Fortunately, it doesn't impact me, because I've got enough money on the platform where I don't have to pay the fee.
Okay.
But anyway, when I got to Australia 2 years ago, I then opened up an account with Vanguard Australia. Yep. So I invest fortnightly $600 a month, $600 every fortnight into my Vanguard Australia account. Okay. And that's who I choose to use just because I've been using Vanguard UK for years. They're a really massive company, so they're sort of safe, reputable, trustworthy. Okay. But other options for people in Australia, Perla is another good and popular app.
Okay.
And then Superhero is another good and popular app. The thing is with platforms, it's a bit like supermarkets. Each one is like different stuff that it's good at. Some are higher price, some are lower price, some are like better meat and fish, some are like better like bread. Do you know what I mean? So everyone's got their own USP, and it's very much the same with investing platforms. There is loads of them, and each one is slightly different, has slightly sort of different perks, pros and cons. The reason why I like Vanguard is because I can just set up an automatic contribution into a low-cost global ETF, and then I literally don't do anything. I set that up. All I do is probably log in once a year and try and increase my contribution. And then log in the odd time to make an extra lump sum payment if I have some money left over at the end of the month. But other than that, everything's just on autopilot, and then my wealth just grows slowly. And actually, the last year has been really good for the stock market. I think a lot of the global ETFs are up about 25% this year. So a very common question I see is, it's like right now you can get about 5% on the cash in the bank. Yep. So it's like, oh well, it's risk free. I might as well do that.
Yeah, I was just gonna ask you, would you put you don't put any money in the bank and you put everything in...
I've got like money for like an emergency fund.
Okay, in the bank?
Yeah, in the bank, which I don't touch. Yeah. I don't use that for an emergency, but then anything else, I personally just invest. Because over the long term, it's almost guaranteed that by investing, you'll outperform inflation and outperform the interest you'd get from a bank account.
Okay, yeah.
And as we sort of said at the start, by saving, it is good to save, and you do need to save for some things. Yep. But your money is constantly being eroded by inflation, and it's impossible really to save your way to wealth. Okay. If you want to actually build wealth, you need to invest. And obviously, we're talking about the stock market. You can invest in other things as well. But I think the stock market it's the best returning asset class over the long term. Yep. And it's so easy and accessible. You can download an app like Vanguard. I'm not affiliated with them. I wish I was.
I feel, do they pay you?
Never.
Have you reached out to them?
I spoke to them once a couple of years ago, but nothing ever came from it. Yeah, they should sponsor me, really.
Yeah, they should. You would mention them. If I have a shot each time you say Vanguard, I'd be drunk by now.
Yeah, that is true. Yeah, I make a lot. The problem is because I've been using them for so long, and I always talk about them. When Vanguard UK did increase their fees, I got like hundreds of messages. I spent like the whole weekend just replying to like comments and DMs of everyone panicking about the fee increase. But yeah, anyway, so get an app, $100 a month, and just get started there. And then, yeah, hopefully over time you can build up your contributions. If you can invest $1,000 per month, obviously you're going to be able to build your wealth much quicker.
Yeah, true. No, makes complete sense.
Does that all make sense?
It's starting to make a little sense, but we're going to go on like a whole tour. There's a lot more left. This is just a start.
No problem.
Yeah, this is just a start. But anyway, so you said Vanguard, Superhero, and one more. What was that?
Perla.
Okay.
Yeah.
Okay, before we get into questions, I'm going to ask you a few like myth busters or something. Is it true? What do you think? And what are your thoughts on it?
Yeah.
Okay. Is investing too risky?
Disagree.
Disagree? Yeah. Oh, okay. Why would you disagree?
It depends like how you like think about the risk. As we obviously talked about, if you have money in the bank, just in cash, that is guaranteed to lose value every single year because of inflation.
But I can be wrong. I have zero knowledge.
Yeah.
But if you put your money in stocks, and what if the stocks crash and there's so much recession going on in the world and then the stocks crash and then your money, if it's valued at 100, it might go to 80. Isn't that worse? Isn't that risk?
That's why it's very much a long-term thing. So there is definitely risk. If you're literally just chucking your money into a random stock that someone suggested to you down the pub, that's obviously a stupid investment.
Yep.
In my opinion, if you are invested into low-cost US or global index funds and ETFs, and you're doing that consistently for the long term, it's not risky. I don't think. Over the last 100+ years, the stock market on averages about 10% to 11% per year.
What is long term? Sorry,
so that's like a 120-year average. So there's so much data.
No, as in like you should invest for long term.
Like
what do you mean long term?
I'd say minimum 10 years. But for me, the long term's like, I'm never going to sell my investments. Yeah. I'm only going to invest more and more. One day I'll live off of them, and then I'll pass them on to my future children.
So you will remove them because you're going to live off them?
Yeah. Okay. So actually, yes, that's another good thing actually. So how can you actually live off of your own? Well, what's the point in doing all of this?
Yeah.
I guess the idea is you can build your pot up to a point where you can then essentially withdraw from it, and it can then essentially pay for your lifestyle.
Yeah, so it'll be such a big amount that even if you withdraw, it's yet growing.
Exactly,
is what you mean to say, and it's a big amount that is growing.
Exactly, yes. Yeah. So you withdraw a little bit, you can live off, but then it's still growing in the background essentially. It's called if people want to look into it, it's called the 4% safe withdrawal rate. And the idea is that you can withdraw 4% of your total pot per year and live off of it forever. That's the idea of it. But you obviously need to get to the point where you need to get it to like $500,000, $1 million, $2 million. Obviously, the hard point is getting to that point. But that's why you can start early, even with small amounts.
Yep.
You can actually get to that point much easier and much quicker than you think. And if you can, live a bit frugally, invest more, increase your income, avoid lifestyle inflation, you can actually take years and years off of your sort of retirement age to then live off of your investments and then get your own freedom back.
Interesting. Out of curiosity, I know we need to talk about this, but what got you into investments?
Yeah, it's a good question. I'm not really sure. I studied economics at university, and I was always sort of interested in like finance and money and investing. And then in between my second and third year of university, in England, it's quite common to do a placement year at some universities. So you work for a year. So I worked as an accountant in London for a year, and I got auto-enrolled into my pension. It's like the UK version of a superannuation.
Oh, okay, got it. Yeah, India has PPF. Yeah, got it.
So it's similar to that. And then that was what got me thinking about investing. I then read loads of books on investing in personal finance. And then it was really in 2018, I then properly started investing every single month of my own money. And then, I've sort of slowly then built it up over time. But I think it was just like reading books, having an interest in it. And then, to be honest with you as well, when I worked that year in London, I was like, I don't know how people do this for like 40, 50 years.
Yeah, true.
I do not want to be working into my 60s. Yeah. And I know if I can just invest now, I can take like 1 to 2 decades off of my retirement age. And that's the power of investing over the long term. So whilst
that's how much you hate working. Wow, we get it.
I'd rather be like traveling or just chilling, or just doing my own business or something. So is investing risky? If you're investing for the short term, it's incredibly risky. Which is why people ask me like, "Oh, I'm saving for a house deposit. Should I invest this money?" I always just say no. Just keep it in cash. I've heard so many stories, and I've had mates myself who have saved up for a house deposit through investing, and then the market crashes and they can no longer afford the house because I've not got enough money. So I would say if you're saving for a goal, just keep it in cash and save, it's fine. But any money you don't need for a short-term saving goal or medium-term saving goal, just invest it. And of course, it is very volatile in the short term. If you look at the chart of an S&P, or the S&P 500, for example, it's literally like a roller coaster over like a week, a month,
even a minute, right? Yeah. Even during a minute, like it just goes up and down, and you're like, shit, that was priced at 500. Now it's priced at 497.
Yeah,
like but very little, but it happens.
Yeah, but there's a good saying: if in doubt, zoom out. And if you look at the chart over 1 year, 5 years, 10 years, 50 years, you'll see it almost goes up in a straight line, and all the sort of crashes and like the busts and booms, just they're almost unnoticeable. So it is risky if you're going to invest for the short term and invest into something random. But in my opinion, if you're investing using low cost US or global index funds and ETFs, and hold them for the long term, it's not risky at all.
Okay.
The riskier thing is keeping money in cash because that then loses out due to inflation.
Okay. Till now, whatever conversation we've had, my understanding, okay, with a person who has no knowledge, my understanding is Vanguard, it's stuck in my head. I'm telling you, they should pay you. Vanguard is the app you should go to. How much does Vanguard charge in Australia, do you know?
0.2%.
Okay. And that shouldn't be, like, that wouldn't, that's fine. Is that normal? As in, like, what I meant to say do most apps charge that much?
Some of them are 0%, but then some of them do charge like a little bit. And I think because Vanguard is such a big, they're the second largest asset manager in the world. So in terms of like sort of a safety point of view and like being reputable, they're really as good as it comes and big as it comes.
You just mentioned 0%. As a beginner, wouldn't that beginner want to go to 0% instead of paying 2%?
Yeah, the problem is with investing platforms, and the reason why I like Vanguard is, it can be a bit of a minefield to work out what fees you're actually paying. Whereas with Vanguard, they're very transparent with their fees. So I know I'm going to use them. You pay a platform fee of 0.2%. And if you invest into an index fund or ETF, the fund will also have a fee. Okay. So the one that I use is one called VGS, which is a low-cost global ETF. And that's got a 0.1...
Guys, get it. He invests a lot of money.
And that's got a 0.15% fee.
Okay.
So if you add those two together, that's in the total fee that I'm paying.
Okay, got it.
Yeah.
Okay, so...
The reason why I like Vanguard is they're very transparent with their fees and they're low fee.
I'm drunk.
Another shot, yeah. That'd be a good drinking game, to be fair.
Oh my God. Oh, imagine if the viewers start doing that. I'm so sure I'm going to say Vanguard at least another 12 times or 20 times.
100 times probably.
Yeah. But anyway, so Vanguard, yes, it's a long-term thing. It's not a short-term thing. It is,
definitely.
If you have goals for saving for a particular reason, don't do it.
Yeah, don't do it. I'd say if you're saving for like a holiday or a house deposit, try and find like a high-interest savings account and just use that. Because imagine if you were saving up for like 5 years for a house deposit and then all of a sudden the stock market crashes by 30% and then you can't then afford the house that you wanted. That's happened to one of my friends before, a few years ago. Okay. And he was heartbroken. It destroyed him.
Obviously.
Yeah. So that's why I just say, just don't. I actually made a TikTok on this recently because someone was saying that they're going to invest their house deposit through a stocks and shares ISA.
Yep.
It could work out if you're lucky. But the problem is, I would rather not take the risk.
Yeah, sure.
But then any money you don't need for any sort of savings goals, I would then say just invest it for the long term,
Okay. I'm so interested. Then I'm like literally sitting like, how do I pay more attention? I usually don't sit like this in my podcast, but whatever. Okay, so that makes sense. And then index funds and ETFs.
Yeah.
And US and global. Like these keywords are stuck in my head.
Yeah.
Is that what I'm saying?
So I personally take a global approach. Okay. So VGS is a global index fund. But because the US economy is the biggest and best, a lot of people that I know only invest into US companies, like the S&P 500. But I personally would rather be globally diversified. And actually, so I go through this in the book actually, as a section about why I use a global index fund rather than a US index fund. And I look at the data over the last 100 years, and essentially the best country is always changing. So about 100 years ago, it was the UK. About 40 years ago, it was Japan. Now it's the US. Who's it going to be? It might be India. India's stock market has doubled since 2019.
Yep.
India might be the biggest stock market in 20 years. It might be China. I don't know. So by taking a global approach, I guess I'm taking all the guesswork out of it. Yep. The things with index funds and ETFs, it's not a get-rich-quick scheme. Yeah. You could just chuck your life savings into a random stock or random crypto coin, and it could boom, but you're more likely to just lose everything. Yep. Which is why index funds and ETFs and very much investing in general is very much sort of slow and steady.
Yep.
Be consistent, do it every week or every month, and then over the long term, you build your wealth slowly.
Okay, and Australia is nowhere close to, like, you never mention Australia in your list.
So the thing is, it's same with Australia and also with the UK, their stock markets are such a small part of the global economy. Yep. So I know the UK is about 4% of the global stock market. Okay. I think Australia is about 2%.
What?
So that's such small, There's actually some like US companies, the biggest ones like Apple and Microsoft and Nvidia, those one individual companies are bigger than the total Australia stock market.
Yeah, Australia's really tiny.
The power of, and same as the UK.
Yeah.
Which is why a lot of people only invest into US funds, but I personally take the global approach. But the thing is, with a global fund like VGS, you're investing into every country all around the world. So even though most of the money goes into US companies, because they're the most dominant, You invest like some into Japanese stocks, some into UK stocks, some into Indian stocks, some into Australian stocks, some into like all countries all over the world.
Just to understand again, because I don't. VGS is not an app; it is a fund.
Yeah. Okay. Yeah. So that's a good question. So, and I go through this in the book as well. This is what I call the 3-step blueprint. So there's 3 steps to start investing. Number 1, you need to choose a platform.
Yes.
Or an app.
So Vanguard, obviously.
Sure.
Yeah.
Number 2 is you actually need to choose an account.
Okay.
So in Australia, your options are essentially either a superannuation or a general investment account. Okay. So most people have a super already through their work.
Yeah.
So they probably can just open up a general investment account, just a normal account. And then it's step 3, where you choose an actual investment.
Sorry, before we go to step 3, you said super or general investment account. What is that general investment account?
So it's just sort of like your standard account that you normally get when you open up in Australia.
As in when you're working, you can open 2 accounts, your salary. Like, where does this account come? Like, can I go to the bank and as a person, I can just open it, or what is that?
Normally on an app. So when you download Vanguard or Perla, you'll normally automatically, as part of the sign-up process, just open up a general investment account, and then you can then invest through that.
Okay, and then how is super related to that? Like you mentioned super.
So super is just like another type of account where so the difference is, I guess, with a general investment account, you put money into it and there's no tax advantages. Okay. But the money's flexible, so you can access it whenever you want. But of course, you may have to pay tax depending on how much gains you've made.
You have to pay tax on your investment?
If you made a gain and you sell it, then yeah.
But if you don't sell it, then you don't, like, as it, right? Okay.
Yeah. But then, but you also have to pay tax on the dividends as well.
Okay, but it depends on a particular amount, right? It'll be after a particular amount.
Each country is different, and this is where it gets a bit more confusing, because each country, like the UK is completely different tax laws to Australia. Yep. It's completely different in America. So I guess it depends if you're listening, you need to look into your own country's tax laws. But you normally will pay tax on any gains once you sell, or normally pay tax on any dividends if they're above a certain threshold. Okay, and what do you know the threshold in Australia? I don't actually know what the threshold is in Australia. In England, no, it's only £500, so it's tiny.
Oh, yeah, 500
for dividends, yeah, and then £3,000 for capital gains.
Okay.
Yeah, in the UK though, it actually works completely different, because we have a different type of account that's tax-free, which unfortunately isn't available in Australia. Okay. Yeah, so I won't go into that.
Yeah, let's not put the UK.
So the superannuation though, that's just another type of account.
You open it in an app, basically, or
so you normally get one through your employer. Yeah.
Exactly. So superannuation should get it.
But you can also open like a self-managed super as well. Like you can go onto Vanguard and open up your own super.
Oh, got it. Now, I think, let me explain it in layman language. Yeah. Correct me if I'm wrong. So basically a super account is created and a money goes there, like a salary money goes to a super account. And then they invest, like the super people invested somewhere, but it can also be manually invested, and we take our super and invest in like any stock that we want. Yeah. That's what. So one is a super account, and then one is the general investment, which is manual anyway. Yeah. Okay, so that is the 2 accounts.
So with the super account, that has got some tax advantages because you avoid tax by putting money into your super. But then the downside is the lack of flexibility, because you can't access your super until down the line.
Oh, okay.
I'm not sure what age it is in Australia. I know in the UK it's 55.
Till you're old. Yeah, let's just say old.
60.
Yeah.
So that's sort of like general investment account is no tax advantages, but it's flexible. A super has a lot of tax advantages, but it's inflexible. So what I normally say to most people is just use a combination of both. And that's what I do.
Yeah.
So I have like 11.5% of my salary every month going into my superannuation. And then of my own money, I then also invest into a global fund on Vanguard through my general investment account. Yeah, a lot of shots.
Yeah. Anyway, instead of tea, we should have got some alcohol.
It is Friday, to be fair. So yeah, it's like choose a platform, choose an account, choose an investment. So as you correctly said, VGS is the investment essentially, that I use.
Oh, okay, fine. So I think things are starting to make sense. I know I'm asking a lot of questions, but because I don't know anything.
I've done a lot of podcasts, but normally they are like the person also invests or like knows as much as me or more than me. So it's very much like
the same level.
Not good for like this is good though, because it's like if beginners listen, hopefully they can understand. You're probably asking questions they would be asking, so hopefully they can help understand.
Yeah, that's it. I was like, I love to do topics that I don't have knowledge about, so then I can ask the dumb questions that a viewer is watching and like, what the hell is VGS? What the hell is EFT?
But yeah, so essentially, if you're in Australia, choose a platform. So say look at Vanguard. Yep. But obviously we talked about a few others. Choose an account. a general account is probably going to be fine for most people.
Yep.
And then choose an actual investment. And I think the actual investment is probably the most difficult bit, just because there's thousands of stocks, there's thousands of index funds and ETFs, there's then REITs.
Are there thousands of
bonds.
S&P 500 or there's only one S&P 500?
So there's only one S&P 500.
Okay.
But a lot of companies will offer a fund that tracks the S&P 500.
What do you mean?
So if you type into, like, if you download an app and type in S&P 500, loads will come up. Because, what's a good analogy? It's just like, I guess you can, you got chicken. You can buy a chicken, but you get like Cole's chicken, or like the nice chicken, or like there's different
free-range chicken.
There's different types. It's a bit like that, where the S&P 500 is just one. It's 500 companies, but then loads of companies will offer a fund that tracks the S&P 500.
So how does it? But then they're the same companies, right?
They are the same companies, but they will charge different fees. So that's why choose the fund that has the lowest fee, which normally is the Vanguard fund, because they're normally the lowest fee fund provider. I should be sponsored by them, really. I'm doing PR for them.
Yes, you are.
Yeah.
Anyway, but okay, fine. So
if someone gets an app like Perla or Superhero, I'm pretty sure if you type in S&P 500, that you'll be scrolling. There'll be loads and loads of options.
Oh, so but you said there's only one S&P 500.
There is only one, but I don't know how to explain it. So, for example, there's other companies. So Vanguard provide funds.
Yep.
But then also a company called iShares provides funds. Fidelity provides funds. HSBC provide funds. So they'll all have their own version of the S&P 500.
Oh, so different 500 companies?
Not all the same 500 companies.
So different percentages of the 500?
No, all exact same.
Then how's it different?
They're all just trying to make money. So that's why I say pick the one with the lowest fee, because then the lower fee, the better.
It's exactly the same, only the fee is different.
Yeah.
Okay.
Because there's another really popular index called, so the S&P 500 is an index. Another popular one is called the FTSE All World. So FTSE All World. It sounds very jargony, but all that is a global index.
Okay.
So it tracks 3.5. So just like the S&P 500.
What do you mean by tracks?
So essentially, it will track the performance of those stocks that are in the index.
Okay.
So the S&P 500, going back to that.
Can we start with, again, I've reached confusion level.
Yeah, no, that's okay. Okay, so the S&P 500 is the 500 largest US companies.
Yep, got it.
So S&P stands for Standard and Poor, and they select the 500 companies that are in the S&P 500.
Got it.
And they're all US companies.
Got it.
What they then do, you got the 500 companies.
Who's the they?
Standard and Poor. So
okay, SOP.
S&P, yeah.
Got it.
So those 500 companies, the fund will then track their performance over time. So essentially as the stock price hopefully grows, the S&P 500 will then go up in value.
Okay. Yep. Got
so
it.
then an index fund or ETF, you can then invest into those 500 companies.
Yep.
And as the index goes up, your wealth then grows alongside it.
Yeah, that I understood.
Yeah.
But then you said different apps, like.
So yeah.
But different. So okay.
So the
it's like how different banks have different interest rates, so different.
Yeah, actually, yeah. You know how like every single bank will offer, you can get a mortgage with them, a savings account with them, a children's account with them, and each one will, like NAB will have it, Combank will have it, but then like each slightly different fee, and that's essentially similar to this.
Okay.
So the S&P 500, loads of companies will offer an S&P 500 ETF.
Yep.
But they all have slightly different fees.
Okay, got it.
But what I was going to say was, there's another very popular fund called the FTSE All World.
Yes, you're mentioning.
So FTSE now, FTSE, that's just a company that selects what essentially stocks to put into this index. And it's called All World because it tracks the whole world.
Okay.
And with this index, there's 3,500 companies or stocks in it that are based all around the world. So you can also, on an app, look up All World, and once again, there will be loads of funds that come up. And you ideally just want to select the one with the lowest fee. But all that index does is sort of, tracks the performance of 3,500 companies all around the world. Okay. So that's like a global index.
So, for example, I can go to Vanguard. I download Vanguard.
Yeah.
I open it and I search for All World.
Yeah.
On the Vanguard app.
I'm not sure if actually Vanguard offer that one.
Oh my God!
Yeah, see that,
shit!
So every platform also offers different funds. So the one that I use on Vanguard is called VGS. So if you type in world, it will come up. I think it's called something world. But there's loads of different indexes, so it can get a bit confusing. But also my approach in the UK, and I've done it the exact same here, I just download an app, normally Vanguard, and then I'll just look for buzzwords like global or world, and then try and find the lowest fee fund that invests all around the world.
Oh, okay. So global, like, use these keywords, and but also just study their performance, right? Like, study their performance and see what they are, not just because the name has global to just invest in.
Yeah, you need to look what it's actually invested into.
Yes.
And if it's invested into companies all around the world, then that'll be a global fund, and then that's what I'm looking for personally with my own investment approach.
Okay, so you look at global.
The reason why I keep mentioning the S&P 500 is because that is the most talked about sort of index in the world.
Okay.
And a lot of the like world's biggest and best investors, like Warren Buffett, they often recommend just put your money into the S&P 500.
Okay.
But I personally take a global approach just because I want to be globally diversified.
S&P 5. Oh, yeah, S&P is US.
Yeah, that's US only.
Got it.
But in Australia, there's the ASX 200. So you wanted to, the 200 largest companies in Australia is the ASX 200. So if you wanted to, you could once again go onto an app, type in ASX, and there'll be loads of ASX 200 funds that come up.
Okay.
And you then pick one and then you invest into it. And then by investing into that fund will then grow as the companies in the ASX 200 grows.
Okay. So fund is basically like a group of things or just one company?
Yeah. It's
a group of companies.
A group of companies, yeah.
Got it.
But then each fund, and that's why it's confusing because there's thousands of funds, each fund will do something different.
And you take the one with the lowest interest?
Yeah.
I'm the best student.
Lowest fees.
Lowest fees. Sorry. Lowest fee.
Yeah.
Okay. I'm a good student.
Yeah. But the reason why it's so confusing and overwhelming is because there's literally thousands and thousands of funds.
Exactly.
Which is why I like using a low-cost global fund.
Yes.
It just keeps my approach incredibly simple.
Yeah.
I could have like 10 stocks and like 14 different funds, but it would just confuse me. I don't want to do that. So I just have one global fund and just put all of my money into that.
So you only do one in one. You don't go like, oh, this is, for example, you did S&P 500. You invested. I don't know what you've invested, but let's take an example.
VGS.
Okay, VGS. Yeah. I was just taking an example. I didn't say. Okay, you invest in VGS. Okay, and then you see Apple is growing up. You will yet not invest in Apple. You'll just keep it to VGS.
Yeah.
Okay, that is your way of investing.
Yeah.
Got it.
So you can try and, it's called, if you want to invest into individual companies,
stock trading.
That's called stock picking or stock trading.
Yep.
It's incredibly difficult. And if someone wants to try it, you can try it. But I mean, I tried it myself many years ago when I was at university. Like, you're reading the company's financial statements, you're trying to calculate discount the cash flows and calculate the intrinsic value of the company.
Yeah.
It becomes very complicated, and it's often just very impossible. Even if a company's good, you then got to time the right place to buy it, time the right place to sell it.
Yep.
It's just difficult.
Yeah.
And using index funds and ETFs, it just makes the approach so simple because all of my investments are on autopilot. I can go about my life.
You're more about long-term investment.
Yeah.
I feel stock trading is more of a short-term short-term trading in money growing, and it has more risk.
Much more risk.
Yeah, much more risk.
It's so difficult. So you got to pick the right company. Then you got to know when to buy, when to sell. And the thing as well with stock picking, what people don't like to admit is a lot of it is just down to luck. There is some skill involved, but it often is like, are you going to get lucky with the stock growing or doing well over the next few months? And then even if it does do well,
yep,
do you sell it and take the profit, or is it going to keep growing? It's just so hard to know.
It is hard to know. And plus, I feel, so my dad has a stock trading company. He doesn't do it. He has like employees to do it for him. But what I've learned or understood, I've not learned, but what I've understood is you need to do it in bigger chunks of money when you're doing stock trading. You can't be like, oh, let's do $100.
Yeah.
You're going to get nothing out of it.
Yeah. Because often like stock traders will just try and make like 0.1% a day.
Yeah.
If you have like 100 like a million.
If you do 100,000,
then obviously
then that makes money. But it's high risk because they sit during the market hours, and then they have to sit.
The problem is though as well, I go through all of this in the book. There's overwhelming data across like every time period where it is just most fund managers, so most stock pickers, will underperform a simple global or US index
stock
fund.
pickers like a UK thing?
Or stock trading. It's the same
stock
thing.
Traders,
yeah, the same thing.
That's the first time I've heard the word stock pickers.
Stock picking, yeah. It's the same thing, I guess. Yeah, stock trading. Yeah. Like, there's so much data over so many different periods that just shows it's almost impossible to consistently pick stocks that are going to outperform a simple index fund. Like investing is I think investing is probably the only thing in life where you can get the average return by just investing into a global index fund.
Yes.
And you will outperform 95% of other people who are trying to buy and sell stocks and time it correctly. Because it's just so difficult to consistently do that.
Okay, makes sense.
So that's really what, and it's only really last probably like 10 years that index funds and ETFs have become really popular because it's such an easy way to just slowly grow your wealth over time. You haven't got to be looking at charts all day, looking at spreadsheets all day. You just automate a monthly investment, whatever you can afford, and then just hold it for the long term.
Okay, makes sense. It's starting to make a little sense, but I want to backtrack a little bit.
Yeah.
And, the main thing is money out here because people are putting in money. How does a beginner set realistic goals, like financial goals for investing? Like, okay, they started with $100, but, sometimes people get overexcited. They're like, oh, wow, my $100 wouldn't happen, but just let's take an example. $100 is $500 already in 3 months. And then they go like, oh, let's invest some $500 or $600, but maybe it's not ideal for them. So how do you set realistic financial goals?
In terms of how much to invest per month?
Yeah, like how much to invest? Like,
I would honestly say, so £100 a month, I'd say is a really good place to start. Because it's not like...
What do you mean Australian dollar?
$100, sorry.
Yeah, sorry.
Aussie dingo dollars. Yeah, $100 is a really good place to start.
Yeah.
Because you're sort of building a good habit, like dipping your toes in, getting your feet wet, understanding it. I would say do that whilst also reading books to educate yourself about it.
Reading books like?
Stop waiting to start investing.
I knew that.
Yeah, end of the podcast, thank you. No, there's so many good books you can read. So one, The Little Book of Common Sense Investing, very good book. The Simple Path to Wealth, and The Psychology of Money. I would say just buy those 3 books. You can read them all in like a few weeks. It's probably like one of the best investments you'll make, $100 for those 3 books. And you'll then know 99% of what you need to know about investing, and you'll know more than the majority of people. And then you'll just be fine because that'll give you sort of the baseline knowledge that you need. But I'd say $100 a month is a good place to start. That's what I did myself many years ago. And then if you can increase your contribution, that'd be ideal. So I'd say once you feel a bit more comfortable, an ideal sort of level to aim for is about 10% of your net pay. So if you get paid, let's just say in your bank account, you receive
100,000. Let's take, so it's an easier number.
Oh yeah.
Yeah.
So if you can just do 10%,
10,000. Yeah. Okay.
So then per year, so then you per month would be like just under $1,000 per month. Yeah, something like that. That's what I'd say. Because 10%, it's not gonna like. Hopefully you can afford that, and it's not gonna completely reduce your quality of life. But it's still a decent chunk that'll be going in every single month. And ideally, if you can increase that over time, it's almost like a sliding scale. The more you can increase that percentage, the more years you're going to take off your retirement. And if you can, if you're in a fortunate position where you have like low expenses because you're living at home, or you got a really high salary, you can honestly invest a lot of money per month, and you can really speed up that path to become financially free.
Yeah,
but I'd say start with £100 at $100. At the same time, read a few books, and then when you feel more confident, increase it to 10%. And if you then increase that over time, that's ideal. At the moment, I try and invest about 25% of my money, 25 to 30% every single month.
But for a beginner, 10% is good.
I think that's good, yeah. Because it's going to be quite nerve-wracking. You're going to want to check it a lot. It's going to be volatile. And I think the worst thing you can do as a beginner is just, start panicking and selling everything. So I think by starting small and then educating yourself at the same time, because the most important thing is actually starting. It's like with the gym, you can devise the best workout routine, but if you never go into the gym, you're never going to make any like gains.
Yeah.
It's the same with investing. You can read hundreds of books. If you never start, you're never going to actually like learn how it feels practically. So $100 a month and read some books on the side. And then once you feel more confident, I'd say try and increase that contribution. Yeah.
Yep. Okay. Makes sense.
Something like that.
Things are starting to maybe make sense. But okay, that makes sense. Like it's 10% of your income, start with $100, and then when you feel more, but keep on educating yourself. Read books, or listen to podcasts, watch YouTube videos like ours.
No, because honestly, the main way that I did it, so in 2017 and 2018, I just read dozens of books and watched loads of YouTube videos. And that told me pretty much everything that I needed to know about investing. And then my approach has been the exact same ever since.
Okay.
Yeah, I think a lot of people think you have to be like in the spreadsheets and really smart. That's another massive misconception. You can get started with such a small amount of money and you haven't got to be smart at all. You just automate a $100 investment per month into VGS or the S&P 500, whatever fund you want, you can pick the fund and then, leave it on autopilot.
Okay, got it. So, I want to go through all the steps, okay?
Yeah.
So because this was one of the things, is step by step, let's do it.
Yeah.
If I, as a person, as a beginner, I was going to ask you, but I think you correct me so I'll learn better, is if today I go and I want to invest $100, the first step would be downloading an app.
Yeah.
And I select $100 for the month, not fortnightly, for the month, because I'm very new at it. I'm going to select $100. The app that I download can be Vanguard, but can also be others, depending on whatever you want.
It's probably actually worth, honestly, there's just like going onto YouTube and whatever country you're in, just typing in best investing app 2024, 2025. I've done a UK version of this year. There's almost certainly going to be like an Australian version, like an American version, whatever, and then watch a load of those videos and you'll probably very quickly be able to work out what a good option is,
Okay, sneaky question just came in my mind. You're in Australia.
Yeah.
But do you yet have your Vanguard UK? Can you yet operate it? Can you do those things?
I don't contribute to it anymore. I just leave all my UK.
So you can have an app where money is left in there, but you can't do anything in that. You can't use it because you're in a different country and different regulations apply.
It once again depends on the rule. It's a bit it depends on your tax residency and the rules of that country. With the UK, I can leave my investments there, but I can't contribute anymore.
Okay.
So all that money is just sat there, and then I'm contributing to my Australian accounts every month whilst I'm here.
Okay.
And then when I then go back to the UK at some point, I'll then probably, I'm not sure what I'll do, but then I'll start contributing to those accounts again, essentially.
Okay. But you wouldn't like remove that UK money and put it in your Australia account?
I haven't, because I think I'm going to move back at some point. If I was going to stay here for good, then I probably would bring it over. But for now, I'm not sure what I'm doing, so I'm leaving both the pots separate.
Oh, okay. Makes sense. But then, for example, you were to move here permanently, like
then I would have to move the money over.
Then you would have to move the money over because you wouldn't be able to use that money. You can withdraw that money.
Yeah, I could withdraw it. Yeah, but it probably would be better, to convert into dollars and use it here if I was going to stay here for good.
Okay, but I'm new. I ideally can't be like Vanguard UK and then download and put it out like my money there.
Yeah.
I can only do Vanguard Australia.
Yeah, definitely. So whatever country you're based in, definitely use a platform that's available in that country. Yeah.
Okay.
So that's why I'd say if you're in Australia, we've obviously talked about a few platforms, particularly Vanguard, but of course don't just follow what I'm saying blindly. I'd say go on YouTube, type in best Australian investing platforms. There's almost certainly going to be loads of videos with loads of views. Yep. Watch a few of those and you can probably quickly work out, because the thing is, as we're talking about, each platform's slightly different.
Yep.
Each has got their own unique selling point. And they've also got different interfaces. So you can always download a few of them and just try them out and see which one you prefer. But yeah, pick a platform essentially is what you're saying. And that's the right first step.
So that's the first step, picking up my platform. Also realizing my risk tolerance. Not that I don't have money in life and then I'm taking the money and putting it in, not risk tolerance, but my financial goals basically. Then the app comes. Then I find a global or world, any
global or world. That's what I do personally.
Yes. Okay. Yeah, I'm trying to take your advice. Global or world.
Yeah.
And try to invest my $100 in it.
Yeah.
And I leave it and I keep it on a monthly cycle.
Yeah.
That's how simple it is.
That's how simple it is. And that's why the subtitle of the book is called Build Wealth with 10 Minutes of Work, because it literally takes. I got my mum set up with investing a couple of years ago, and it took like 8 minutes.
Okay.
Yeah. So I think everyone thinks it's daunting. And it can be daunting, but the actual process of getting an app, it's almost like signing up for social media. You put in a few personal details, and then 5 minutes later, you have it and you can start investing.
Okay.
I think gone are the days where it's like the Wolf of Wall Street and you call up someone, it's like, buy this stock, $1,000. Like now it can be so easy and just done on autopilot and cheaply, and it only takes a few minutes to get started.
But are there any hidden costs?
So that's going to depend on the platform.
Okay.
And that's why I like using Vanguard, because they're very transparent about the fees they charge.
Yeah.
But there can be, the main costs you'll pay.
As a beginner, would there be any hidden costs that they should be aware of?
Yeah, so the two main costs that you'll pay will be the platform fee. Mm-hmm. So each app or website or platform will charge a fee.
Yep.
And then secondly, a fund fee. So each index fund or ETF will also charge an actual fee to have your money in that fund. So if you add those two together, that will then be the total fee that you pay.
Okay.
But there are other fees to be aware of. So if you are buying from Australia, US stocks, you're also probably paying FX fee for conversion. There could also be, depending on the platform, you might have to pay $1 fee to actually make a trade.
Okay.
Which is why if you're buying and selling loads, and might end up paying loads of fees, like FX fees, trading fees, all of that stuff. Okay. Which once again is why I'm just a massive fan of the automate low cost index fund approach, because you're only investing once per week or per month, and you're not paying these massive buying and selling trading fees the whole time.
Okay, got it. So, but these are few things, and apps always tell you you're not hidden with it, right?
Yeah, you can, once again, if you like a platform, say like Perla, you can just Google Perla fees. Okay. And then they should be transparent on their website. If you've got a platform and it's a bit muddy, like you can't really work out what fees you're paying, that is the biggest red flag. And I would say don't use the platform, because you want to know, ultimately it's your money. And the way to think about it is the less you can pay in fees, the more money you have in your own pocket that's growing over the long term. Okay. And I think a lot of people, so this happens a lot of people use financial advisors and all this other high tech stuff, and they pay a 1% fee. It doesn't sound like much, 1%, but if you pay a 1% fee and you compound that for 30, 40 years, that'll cost you literally tens of thousands of dollars, if not hundreds of thousands of dollars, which is why it's so important, where possible, to reduce your fees as low as possible. And then you've got, more money working for you in the stock market. Okay.
On that, I want to ask you, do you need to have a lot of money to, start investing?
No, you don't. Don't get me wrong. If you have a lot of money, you can, of course, build your portfolio much quicker. But starting small is great, because you're going to get your sort of toes wet, start building a good habit, get used to investing. The $100 a month, I think, is perfect, particularly if you're a beginner and you're a bit nervous. $100 a month, just do that for a few months, and you can slowly sort of get understanding and get used to the nature of the market. But that's the beauty about investing nowadays. And it's only really the last 10 years this has happened, but it's now just so accessible, so easy, so quick, so cheap to actually get an app and start investing. And that's why, the biggest risk is not investing, and you can't afford not to invest. Otherwise, just be working your whole life, waiting for that monthly paycheck, saving. Yeah.
That's how I started my business, but it is a lot of work. But one reason, as a new person who's not invested, I'd say I've never invested. Yeah. Why I also never invested is because I thought it's really complicated. But I discussed these steps with you, which is really easy, and literally, like you said, 10 minutes. It sounds like 10 minutes.
So unfortunately, the financial sort of industry is a bit snaky. They purposely make things sound complicated, so they can charge people high fees. So a lot of financial advisors will say fancy words to try and confuse you, to make you give them your money, and then they charge you a fee, and that's the thing. So that's why it really can be simple to start investing. But a lot of people use jargon to try and sound smart or charge you a high fee, where it doesn't need to be difficult at all.
Okay. And what are some mistakes that beginners can make? And did you make any mistakes?
I made loads of mistakes when I first started. So first of all, I opened up a investing account with my high street bank. So
what is a high street?
Just like a normal bank.
Okay, normal bank. Okay.
So generally speaking, banks aren't a good place to invest. You're better off using an actual investment platform, like we've discussed a few in this podcast.
Wow, you didn't say it. Shit. Someone's not going to be drunk.
So I'm sobering up. I'll save it. I'll give another 5 minutes to sober up. But that was one mistake I made. Yeah. Another one, which I think is a very common one, I was just investing random money into random stocks that I'd see people talk about online. Yep. So there's a thing called stock tipping, where people tip. It's a bit like when you bet on a horse, they'll tip the horse, this one's going to win, it never wins. People do that with stocks as well, where they're in online forums, they'll I'll say this stock's going to go up, and I essentially invested money based on all these tips. Just don't do it. It's so hard to pick stocks anyway. If you are going to stock trade, you need to do your own research, and it's a lot of hard work. But I was investing my money into random sort of tips I'd see online. Another one was high fees. So this bank that I was using charged a £12.50 trading fee, so $25 per trade.
What?
And
were you making any money?
No.
Okay.
And on top of that, there was also an FX fee. So I was only investing a small amount, and I was paying a massive amount in fees. And it was just, once again, stupid. Another mistake was I used to check my portfolio every single day.
Okay, you shouldn't check it every day?
The less you can check it, the better, to be honest with you.
Okay.
Because especially if it's a long-term thing, you're going to be doing this for decades and decades. Just automate your monthly contributions and then never check it, essentially. But I was checking it every day. Then you start getting sucked in. And what you got to realize is the media or the newspapers and like it's all clickbait. They're either like euphoria and everything's amazing, or it's like, oh, World War III, everyone's going to die.
Yeah,
and that's what gets them clicks. But then people then get sucked into that. Then they start buying and selling
But
stocks.
can I tell you, that's what sells. If you give like a normal, if you're not name this, stop waiting, start investing, just like invest.
Yeah.
No one's going to be like, they'll be like.
Yeah. That's why like YouTube videos, there's one called like how I made $1 million overnight or how I lost $1 million overnight. They would have millions.
Today
they would have loads of views.
I uploaded a podcast today. It's called How to Make $1 Million in 1 Year.
There you go.
Yeah.
That'll get loads of views.
Yeah.
But then like if you then upload like a more sensible title like how to grow your wealth slowly over time, no one wants to listen to that because everyone wants to be like excited. But
you don't need to be scared or excited.
Yeah.
Yeah.
That's what they want it to be. But realistically, it's just very much like being consistent, setting aside a portion every single month, and then letting it grow over the long term.
Okay, fine. So these are mistakes that you know.
So that's for all the sort of 4 or 5 mistakes that I made in my first few months of investing, which cost me a bit of money. But once again, that's why it's good starting small, because if you are going to make mistakes, it's better to make them with a few $100s rather than like thousands of dollars.
Yeah, true.
So hopefully you can avoid those mistakes now that we've gone through them.
Yeah. And then he's recommended you Vanguard.
Shot.
Also, how should you mention this? Okay, so how should like beginners deal with fluctuations? But you said it's a long-term thing and you should not check it. And because what happens is people, they start emotional investing.
There's a really good book called, which I mentioned already, The Psychology of Money.
Okay.
I'd honestly say just read that book. It goes through, as the name suggests, a lot of the sort of emotional side of investing. And these, the sort of, if you look at the stock market in the short term, it's always volatile, and that's how it always is. But if you zoom out a bit, you can see over the like 1 year, 5 years, 10 years, 30 years, it almost goes up in a straight line. But when you zoom in, it's like a roller coaster. But that's why that's a really good book. It sort of just like reframes the way you look at the stock market and just sort of understands that it's going to fluctuate. But over the long term, if you believe, the world is going to continue to become more productive and innovative and make more products and better products, then the global stock market is then going to grow alongside that, essentially.
One just random thought came in my mind. So the S&P 500.
Yeah.
Do the companies keep on changing in it?
Yeah, they can change. Yeah, I think they normally change every quarter.
So when the companies change, supposing you invested in S&P 500 in 2024.
Yeah.
Okay, let's take 2020.
Yeah.
And then companies change by 2024.
Yeah.
Your money remains at the new S&P 20.
Yeah, and that's the beauty of it.
Not with the old S&P 20.
And that's a really good point. That's the beauty of index funds and ETFs. So someone once, when I've done a podcast once, someone explained this to me as saying sort of like index funds wipe their own ass. Because what it means is you're constantly investing in the best companies. If one company failed from the S&P 500, went bankrupt, another company would take its place. So
your money, if it's diversified, it's not your business.
It's one company in the 500, but of course, so that'll go bankrupt, then another company will take its place. So you're constantly
So your money that was invested in the bankrupt company actually gets removed and it gets invested in this new company, or that money that was in the bankrupt goes in a loss, but you've invested in multiple.
Yeah, exactly, yeah. So if you only had invested into that company, you lost everything. But because you have 499 other companies, whilst it may take a small hit, it won't be as noticeable. And then another company will take its place. So you constantly own the best 500 companies.
But then if you invest a large, like over a period of time, for example, you've invested 500,000 so that it's easy to calculate stuff, okay?
Yeah.
500,000 you've invested, which is also too small a number.
Yeah. That's a good number.
Yeah, let's just take it for now. Okay, let's take 100,000 so it's easier to calculate, even 500,000.
Yeah.
Assuming it's a very big money, okay, a very big amount.
Yeah.
And if one company takes a hit and, if 100,000 is equal to 1 billion, let's take that valuation.
Yeah.
Then wouldn't that affect it or no?
It depends really. Because so of the 500 companies in the S&P 500, the largest companies will carry more weight. So if like...
So it's not distributed equally?
No. It's called, it's a bit more technical, but it's called, essentially, it's called a market cap weighted. But what that means is, essentially the bigger and better companies make up a larger share of the index fund.
Okay.
So in this example, of course, Apple is one of the biggest companies in the world.
Yep.
So if that went bust, that would cause a massive hit in the S&P 500 and it would drop. But the point I'm trying to make, I guess, is because you're diversified by having hundreds of other companies, it won't completely, whilst there will be a negative impact in the short term, it won't completely wipe you out like it had done had you only invested into that one company that failed.
But for example, you invested all this money, okay, to, let's say, retire at 40.
Yeah.
Okay, and at that time, Apple took a hit. And then wouldn't that affect you? Or the interest rate that you've gained, it's not the interest rate, sorry, it's the...
like capital gains.
Capital gains that you've gained, the return that that would be higher. Would you say that or no?
Yeah, I mean, so I guess one of the risks of investing is as you get to approach to when you want to withdraw it, what happens is there's a market crash.
Exactly, that's it.
So it's unpredictable, and if it happens,
so there is risk.
It's unlucky. But what you can do is, as you approach retirement, a quite common strategy is you move some of your money into bonds rather than stocks, because generally speaking, bonds are lower risk, and they're not as... Over the long term, the stocks are the best performing asset class, the stock market. But maybe when you're 10 years from retirement, you could switch to like a 60% stock, 40% bond fund. And then if there was a crash in the stock market, you'd be less negatively impacted. I personally won't be doing that. I'm not a fan of bonds, and I'm just always going to be invested into global funds. And then if it does take a hit, the market always recovers and goes high over the long term. So if I was literally going to retire next year and it crashed 30%, it would be unlucky, but I would just continue holding and then, continue investing. And then the market always bounces back.
Oh, okay.
And that's why I'm saying, if you look at the chart of like VGS, the S&P 500, you'll see that there are crashes all the time. And that's another very common thing as well. There's literally crashes and dips every year. Okay. So on average, I think there's a 10% fall in the stock market every 1 to 2 years.
Yep.
So it happens all the time.
Yep.
So I've only been investing for 7 years, and I've already had my whole first year, I was spent at a loss. There was the 35% COVID crash. There's then been record high inflation, record high interest rates, World War III pretty much, of like Russia, Israel. There's been like lockdowns. There's been it's been honestly probably one of the worst times ever, all this stuff, and the stock market is still going up. There are little crashes along the way.
Like it's gone up and down. Yeah.
It's always up and down. If you zoom out the last sort of 7 years I've been invested anyway, all those sort of crashes just look so minor essentially.
Okay.
So it would be unlucky if you were going to withdraw it next year and there was a crash. One option is to move some of your money into bonds or even cash if you're really risk averse. But the market always bounces back. It always has, and I believe it always will, which is why I'll just continue to invest and hold for the long term.
Okay. Now I'm understanding things. I'd say it's getting me excited to start investing. I'm not even kidding. It is, but and maybe I might just go home and download an app that starts with V.
Save the shot.
Yeah. No, can't. I'm so sure. No, they can't drink more.
No,
they'll stop watching the podcast.
Yeah. So is everything I'm saying, does it make sense?
Yes, it is making sense.
Yeah.
It is making sense.
Because I think that what I probably didn't appreciate is when I normally explain things, I normally explain it to people who already invest in.
Yep.
But obviously you're asking some good questions, so hopefully people who are listening can also understand it.
That's what I'm asking, because I couldn't understand. I was so confused in the start. I was like, what are these crazy terms? SOP, VGS?
Yeah. It is a bit confusing, but hopefully it's helping.
No, it makes sense. It does make a little bit of sense, is what I'd say.
Yeah.
And I at least I would say you should also do your own research.
Yeah, you definitely.
Yeah. This is advice from an expert, no doubt, but you should do your own research as well.
Yeah, you definitely got to do your own research.
Yeah. You can't just be like, oh, Ryan said it, so I will do it.
That is my personal thing is I want it to be as simple and as passive and as automated as possible.
Yep.
I want to have no involvement in it at all, which is why I just use one global fund. And in Australia, that's VGS. Of course, there are so many options available. And the good thing with investing as well is, which I've not mentioned before, if you did believe in a certain company or a certain industry, you could invest into it.
Yep.
So if you're a big believer in, I don't know, some specific company, you could just put 10% of your money in that stock. It's complete, and that's, I guess, the beauty of investing is you can invest into whatever you want.
Yep.
You haven't even got to invest into the stock market. You can just invest into property or crypto or something else. Of course, the stock market is very easy and accessible these days. But yeah, you haven't got to do what I do. You can invest into a different fund, a range of funds, a range of stocks, whatever you want.
Okay, got it.
But my whole thing is obviously making money simple, trying to make it as simple and as easy as possible.
You're literally making it simple.
And I think if you can understand what you're doing, then you're more likely to stick to it for the long term.
Yep.
And with investing, that's the most important thing, sticking to it for the long term, because it's really, the wealth is built in decades, not in days. It takes decades and decades to build that massive pot to then one day live off of it.
Okay, makes sense. Okay, we're just going to touch base a little bit on this, but what is your advice? Once someone is, they've gone from beginner level to advanced level in investing, except investing more money, is there another way to scale up? Like, at least I've seen a lot of, I've heard some influencer only say it, but can't remember in the back of my head, something about compound interest and some things, different things. And
yeah, so compound interest is the most important concept in investing. So all that is though, and it is quite, people say it a lot and people do get a bit confused by it. All it is where your gain makes a further gain.
Yep.
So you think you invest $100 and you make $10, let's just say, in year one.
Okay.
You could withdraw that $10, but if you made another 10%, you'd only make $10 more in the next year because you withdrew the gain. If you keep the gain invested, then in the following years, that gain will then go on to make more gains.
Okay, got it. It's like if $100 became $200 and you didn't remove the extra 100, then your gain, and it's 10%. So the 10% first was on 100, then it'll be on 200, then it'll be on 300.
So it's literally you get the return on your own contribution and then the gain. And then it's a really good analogy. It's almost like pushing a snowball where it starts really, really small, but then over time it becomes exponentially bigger and bigger. And that really is compound interest where...
So it's the same thing, like doing on VGS or doing like...
so
you don't remove it, like how you're not removing your money, you're waiting. So you're letting it compound.
So by leaving everything invested...
I feel so smart.
It will compound,
Oh my God.
There you go, you got it.
Yeah.
But no,
guys, ask me for advice. I'm kidding, don't ask me, I don't know shit.
But no, compound interest is the most important concept when it comes to investing. And that's why if you're able to start early, even with very small contributions... It's so important because even $100 today, if you're say 20 years old, that can literally compound for 20, 30, 40 years. So you have so much more time that initial contribution can keep making gains.
Okay, yeah, that was, I totally derailed you from the question that I was asking.
No, to answer the question though.
I'll ask the question again so people are not confused what we were talking about. How does the person scale up, once they go from beginner level to advanced level? How can they scale up except investing more money?
I would actually say, invest more money. If you want to, you can dabble in like stock trading and other stuff. You can give it a go. I just think that most people are literally not going to make money doing it because it's so difficult. And if you want to, you can actually open up like dummy accounts and make like...
What are dummy accounts?
Like you can just like, or you can almost like just write down, okay, today I'm going to invest into Apple at $200 and then see how you'd have performed over the 1 year or 6 months. And what you'll probably find is you probably underperformed the return of what an index fund would have given you.
Okay.
So if you wanted to, you could dabble into like stock trading. But personally, for me, all I'm going to do is just invest more money because I know that it's difficult.
You literally make it simple.
Yeah.
Yeah.
You can like invest into more funds and more stocks, but it just sort of convolutes and overcomplicates the approach, and you probably won't get any additional return by doing that.
Got it. Okay. Any advice, last advice that you would like to give?
Stop waiting to start investing. No, honestly though, the most important thing really is just to get started. I know we said it a few times, but by actually putting in that first $100, $1,000, whatever it is, you'll then actually like understand how the process works through setting up an app, understand how the market fluctuates. You'll realize there's all these like clickbait headlines and you can get sucked into it. So if you can just start investing with a small amount and then read a few books that we mentioned along the side, hopefully you'll then have like a sound sort of level of financial education, and that'll then hold you in good stead over the long term. Investing, like I think a very common misconception is it's like Wolf of Wall Street. It's like exciting, but
it is. It looked. The movie was amazing.
The movie was good.
Yeah.
But real investing is actually literally just like watching paint dry.
Okay.
It's just slow and steady.
I've not seen that movie though, but yeah.
It's a good one as well.
Okay.
But yeah, so it should be slow and steady, and there should be nothing like exciting about it. You're just doing it consistently, but then you got to try and keep in the back of your mind why you're doing it. And ultimately, it's hopefully so you can give up work earlier, retire, achieve financial freedom, all of those sort of good perks that come along with it. And of course, if you are in a fortunate position where you can invest loads, then you can really, really speed up that process to achieving freedom.
Okay, amazing. Thank you so much, Ryan. That was a lot, but really interesting. And you actually made it simple because you didn't be like, oh, there's this. You said one app all the time, and then two things, which is SOP and Global. VGS.
Yeah, I'd say that are two ones to look into.
Yes.
The thing is, you can, and that's why I think it's so difficult. When it comes to the actual investment, there are thousands of options.
Yeah.
And if you want to, you can invest into 10 different funds and 15 different stocks, but you don't need to. It's sort of my approach. You just need.
Have you tried doing all of these things before?
Yeah, when I first started, that was a lot of mistakes that I made, like using high fee funds, trying to pick individual stocks, like investing into overseas stocks. And then luckily though, through reading books, I've realised all of that is largely pointless. So just by using now, index funds and ETFs, that's all I do every single month.
Can you name a rich person who is like rich by like doing what you're doing?
Oh, there's a really good book as well called The Millionaire Next Door.
Okay.
Which essentially, it's a US book, but it's just about how, I think it's like 80% of millionaires are self-made. Most people think so very few people actually inherit their money or win the lottery. Most people are self-made. And
I would love to inherit it though, but
it would have been nice. And then the main way that people got there is just by doing simple stuff like budgeting, investing every single month, and then doing that for like decades and decades. Another common misconception is you see a lot of bullshit on like social media, like Lambos and all this stuff. The average age of a millionaire is also about 55 to 57.
Yeah.
Everyone thinks like you got to be a millionaire in your 20s. Very few people are. The stuff you see on social media.
It's not easy. Like it's very few people
on social media. So it's all about being consistent and doing it for the long term. And that's like another really good book that sort of shows how the consistency over decades is what gets you to that sort of millionaire status.
Got it. Makes sense.
The only, because in terms of if you want to become rich quick, the only real ways to get rich quick is inherit loads of money.
Marry a rich guy or girl.
Actually, marry a rich person. Actually, I didn't think of that one. Inherit loads of money, but that's out of your control. Or by starting a business and selling it. But starting a business is very risky. It's a lot of hard work. I think 90% of businesses fail in the first 3 years. Like it's very difficult. Or maybe OnlyFans nowadays. That's another way to get rich.
Yep.
But so like it's actually very difficult to get rich quick, but it's very, very easy to get rich slowly. The problem is no one in this day and age has any patience. It's all like scrolling, instant gratification. But if you can understand, and it's all about balance as well, because you need to obviously enjoy your life, like travel, have nights out, go to nice restaurants, all of that stuff. So it's a balancing act, and it's going to be a different sort of balance for everyone. If you can balance enjoying today whilst getting wealthy slowly over the long term, then you got the best of both worlds, where you're securing your financial freedom over the longer term whilst also enjoying today.
Okay, makes sense. One last question, it just popped up. What age would you remove your money from your fund? Like what age would that be?
Never.
But you said you would remove like a little bit.
4%. Yeah, I don't know, to be honest with you. Probably not at least for another, I reckon maybe 15 years.
15 years.
It depends how much I can build it up to.
Okay.
But I'd say, it sort of depends. Because I'm still like working a 9-to-5 job at the moment and then making money simple on the side. And then obviously investing as well, my own like salary. So it sort of depends how much I can get my investment pot to. But if I can get it to a point where it could cover my expenses, I would definitely like start living off of it. Yeah. It's not at that point yet, unfortunately. Maybe in 15 more years though, I can be there.
It's a waiting game.
Yeah, it's a long-term goal.
Okay, amazing. Now it has been totally insightful. Let's get to some fun part, which is the rapid fire.
Fun.
Yeah, this was fun, no doubt. Yeah, totally fun, guys. Was it fun? Anyway, but let's get on to the rapid fire round.
Yeah.
And if you give me some nice good answers, you get a gift hamper, which is a Humans of Australia tote bag for you.
Oh, nice.
Yeah. Let me keep it.
Custom bag as well.
Yes. Anyway, so let's start. Very easy. That's super easy. Tea or coffee?
Tea.
Oh, wow. Favorite cafe?
English breakfast tea. Favorite cafe? Probably Georgie Boy on Bridge Road.
Okay, yep.
I always go there.
What's the most overrated thing about Australia?
Overrated thing? Oh, that's a good one. The drinking culture. It's not,
wow, you know what?
I thought Australians could drink. Some of them can, but It's just not the same as the pubs in London, unfortunately.
Oh, that's your reason.
But I've even got Australian mates that have been to like London, or you go to like a football match, and it's like it is just different over there. The drinking culture, it can be a bit too much. It's much more chilled here, which is actually good for me.
You're the second person who's today you're my second podcast, right? That I'm shooting.
Did they say the same thing?
But their reason was totally different. But they said alcohol, but they're like, yeah, people drink too much and they shouldn't drink. And you're like, total opposite.
That's probably the English coming out.
Wow.
Yeah, you can't really beat those little small posy clubs in London, especially around Christmas. Yeah.
Are you going back home for Christmas?
I went back recently for the book launch, so I'm here for Christmas.
Okay.
My first Melbourne Christmas.
Is it your first Christmas?
I'm going to the Boxing Day test.
Oh, nice. What's the most underrated thing about Australia?
Underrated? Good question. I'd actually say how easy it is to get around, like the trams. Because in London, to get anywhere, the tube takes like half an hour, 40 minutes. You go well far underground, takes ages. Whereas here, I guess because I'm in Richmond, I jump on the tram, I'm in the city in 10 minutes, can go anywhere down to Chapel Street in 10 minutes.
Have you been to the suburbs?
A little bit. I normally stick to the suburbs around the city.
Yes or no? I don't agree with you. If you go to the suburbs, it is horrible.
Yeah, okay. So that's only my personal
Yeah,
viewpoint.
that could be your thing, but if you go to the suburbs, if you don't have a car, you can't do anything.
Yeah, that's the first one that came to mind though. There probably are some other ones, but yeah. For me, the transport is so much easier than...
Wow, London is worse than this?
Well, just like the tubes, particularly during rush hour, when I was working in the city, like you're literally like a sardine in the genuine...
Listen, I am from Mumbai. I don't know if you've heard about Mumbai locals.
Is that bad?
It is. There's this one station, okay, which is like main station because it intersects with all different lines, Central Line, Western Line, whatever line.
Yeah.
That you need to stand at the door. With the rush you get out, and with the rush you get in. Like you don't need to take effort. It's that full.
Yeah, that's similar to London. Whereas here, the tram, it's just never busy. It's so nice.
But people don't utilize space completely. Like they don't move in. There's like at least 10 or 20 people more can fit in, but they don't move in. But anyway, being friends with an ex or ghosting them?
Well, it depends on the situation, I guess. I'd probably easier just to not speak to them again, I think.
So you'll ghost them?
Yeah.
Yep. Okay.
It depends, but yeah, I'd say that's probably the easy option for both parties involved.
Oh, okay. But you are ghosting them, so you are ignoring them. They might be reaching out to you. So you are the bitch in this situation.
I think, I don't know.
You're not the bitch, that's a bitch move, sorry. I didn't mean to call you a bitch.
But if you speak to them and you're not going to get back together, then it just makes everything worse. So
you ghost them. Okay, so you're the bad guy, but whatever. Kidding.
Long term is the nice thing to do. Short term is the bad thing to do.
You're always the long term guy. Okay. For 24 hours, if you can make something for $1, what would it be? Not the Vanguard app, please.
Probably like Ferraris.
Oh, okay. Interesting.
But I made them myself though.
No. And you can just be like, you can also make a house, you can make anything. Doesn't matter.
Yeah, maybe. Probably Ferraris or Lamborghinis. Make like thousands of them.
Do you want one?
I'm not actually that fussed. If I had loads of money, if I had like millions and millions.
Then why do you want to make a Ferrari?
Because I can sell them.
Oh, so you buy a few and then you sell them.
Yeah, buy like $100, get 100, sell them for
Smart
$250
thinking.
each.
Yeah, good one. What's your travel hack?
Travel hack? Honestly, always just bring an empty water bottle with you.
Oh my God.
I always used to buy water at the airport and it's like £5, it's like $10 for a bottle of water just because you're in the airport. Everything's triple the price. But I always now bring an empty water bottle with me.
You did, like you did.
I've done it here, yeah. So I can just refill it.
I can't believe you're the first person who's got their own bottle at my podcast. And you're the first person who wore shorts to my podcast.
I know. A lot of firsts.
Yeah. Anyway, 3 local businesses that you think should be viral.
Humans of Australia.
Oh my God, thanks. You won this.
Yeah, thank you. That's a good question, actually. The local cafes near where I live are all pretty nice. So maybe, or maybe some pubs.
You can name them.
Pubs, actually. Drunken Poet, the Irish Times, and Caretaker's Cottage.
Oh, okay.
I reckon they're the 3 best pints of Guinness in Melbourne.
Oh, okay,
so
great.
I'll say those 3.
Perfect. You did relatively well. So this Humans of Australia bag is for you.
Only relatively.
Yeah.
Thank you.
No, but you were quite insightful. And to be very honest, it was lovely talking and lovely understanding. You did truly make money simple, is what I'd say. Thank you for being so unfiltered.
No problem.
Yeah.
I hope that was helpful for everyone listening as well.
Yes.
I mean, if you haven't got any more questions or anyone listening, feel free to just DM me on Instagram at any point.
He replies, guys.
And
He's not like those people who doesn't reply.
Yeah, I always try and reply.
Yeah.
I don't obviously like know everything, but I obviously follow a set approach. That's what I try and like teach and preach, and I have done for numbers of years. But the most important things we said is just to start investing, because that's the main way to build your wealth. So yeah, but any questions, give me a shout anytime.
Yep, I'll put his link in the description below, and don't forget to subscribe.